A big red day in the market. We're not quite closed yet, but the Nasdaq's looking at 1.8%. It touched 2% down. Guys, if you're new to the channel, you're going to see that I like red days. I want you to have the same outlook. I want you to look at red days in the market as an opportunity, as a start for something. I don't believe in buying the dip. What I believe in is looking at companies and making sure you can buy them below value. Today, we're going to go through 3 companies that are reporting: Uber, Ferrari, and then AMD reports after hours. We will get to that shortly. But I also want to talk about just the day in general. Tech took a big hit today. As we always say, when tech is up a lot, when it falls, it's going to be the biggest leader on the fall side. S&P is down 1%. Dow is down 0.43. NASDAQ is down 1.76%. Because the NASDAQ led the way up, it will lead the way down. Much like 2000. We just passed the 40 mark on the 10-year PE ratio of the market. That's pretty high. It's only happened one time before, and that was back in 1999. You know what happened after that? We had a sideways market for about 13 years and another bubble crash afterwards. So what did Uber report? Well, Uber beat on earnings and they beat on revenue. Revenue of $13.47 billion, beating $13.26, and then 81 cents per share in EPS, beating 68 cents, a 19% beat. But guys, when you have a red day in the market, it is hard, even with good earnings, to have a red day overall. It got as low as $90 today, but it's settling here around down 5%. Now, if you've watched this before, I like Uber. I love the fact that a few years ago, their CEO, Dana something or other, said, we are going to focus on cash flow because that's what the market wants now. And he did a great job of doing that. He's done a fabulous job of converting this company from the super growth startup to still growing, but also, what are they doing? They're generating cash flow. Let's pull up their earnings release right here, because a lot of good stuff here, guys. Look at this. He says, Uber's growth kicked it in a high gear in Q3, marking one of the largest trip volume increases in company's history. Trips during the quarter grew 22% year over year to 3.5 billion trips. Guys, that's incredible. 3.5 billion trips in one quarter. This company, there's very rare that I would say a company changed an entire economy. That's used so loosely. I think Amazon did. I think Dell Computer did. I think Microsoft did. I think Uber did. Uber changed the way in which we look. I mean, nowadays, who cares about owning a car if you live in a big city? Just Uber. It changed the game so much that there are other companies that have come out to try to compete with that. I look at people. I was watching a show last night on Apple TV with my wife. The last thing my husband said to me, or last thing he said to me, or something like that. It's a good show with Jennifer Garner. But in the show, they're taking taxis everywhere. And I'm like, who takes taxis anymore? What are you, some kind of loser? Like, literally, I was watching the show going, why are you taking a taxi? Don't take a taxi. There's Uber. So I thought to myself, there must be some sort of deal they had or something. I don't know, whatever it was. Gross bookings grew 21% year over year to $49.7 billion. $50 billion in a quarter. Revenue grew 20% year over year to $13.5 billion. Now you might be wondering, well, Paul, how can they have revenue of 13.5 and bookings of 50? Well, remember, they pay out how much to their drivers, right? They can't sit there and they can't count that as revenue. This is their revenue. I love the fact they're doing that. Income from operations only grew 5% though, to $1.1 billion. Net income was $6.6 billion, which includes a $4.9 billion benefit from a tax valuation release. So don't get excited when you see $6.6 billion. You got to take out the 4.9. I read this as $1.7 billion. This is the reason why it's important to read financial statements and these reports. Now keep in mind, I'm never going to tell you to make a decision on a company based on an earnings release. We think about the future. We think about long term. But it's fun to go through these things, see what the company is doing, see what they say on earnings calls. But I encourage people to use these earnings releases when they fall hard as an opportunity to buy a great company that has a temporary issue that people don't like. Let's keep going. Net cash provided by operating activities was $2.3 billion, and free cash flow was $2.2 billion. So look at this. Free cash flow is cash from operations less your capital expenditures. Their cash from operations is 2.3. Their cash flow is 2.2. That means $100 million in capital expenditures. This is a very, very low capital intensive business. That's what we love. You love it when a company doesn't have to keep investing in itself to grow. Why? They're using everybody else's cars. All they have is software. Everything else is everybody else's cars. There's no reason to mess with things. That's what I love. That's what I love about this company. Okay, Q4 outlook. They expect gross bookings of $52.25 billion to $53.75, which would be 17 to 21% growth year over year. And then EBITDA of 2.4 to 2.5, which would be 31 to 36% year over year growth. This is one of the best companies out there, guys. But remember, on this channel, we're not here to just buy a great story. We're here to buy when a great story and a great price can meet together to be below the value we figure out for the company. If you're new to the channel, I want you to do me a favor. I want you to hear me out here. We sit there and talk different than all those other YouTubers. We're here to teach a process of how to invest. That process takes the emotion out of investing and says, let's look at the data, let's look at the story and see how they meet. You can understand that a company in the last year like Uber can have a low price of 60 and a high price of 102 and realize that the company's value didn't really change that much, but the market price did. We're here to teach a process on how to determine a company's value and then also take advantage when the price falls. If you like that, if you like hearing updates in the market, if you like understanding a little bit more about investing, I need you to do me a favor. I need you to subscribe to the channel. This is going to be a channel that's going to change the way in which you invest and look at money. It will make you a better investor. That is something that I can almost guarantee. I won't quite guarantee it, but if you put in the time to listen to videos, your thinking will change. Uber is a $200 billion company. They've got $8.5 billion in free cash flow. Look at this. Their 5-year free cash flow is 2.6. Their 1 year is 8.5. This is what their free cash flow is doing. That's what's awesome. In our community, we actually have a buy rating from our investors, from the people in our community, with an average intrinsic value of $121. So our community members like this. Our community members love this company. That's what I like about this. All right. Now, a really important metric we look at is return on capital. What this means is when they invest money in the business, do they get a good return? Now, it's not great. It's 4.8%. But in the last 5 years, it was 5.5% on average. So it shows that they're trending in the right direction. That's what we like seeing. Great growth rates, great gross margin, 40%. And look at this. Profit margin last year, 26.7%. 5-year average is 2%. They are focused on profit. Let's see what the 8 pillars show us. All right, a lot of X's. We've got revenue growth, net income growth, cash flow growth, all positive. I'm not worried about these 5-year numbers. All of these are 5-year numbers. I don't care because look how different the 5-year numbers are in cash flow. Massively different. So I'm just ignoring that. That's what I want people to realize about our 8 pillars. It tells a story. The story this is telling me is 5-year numbers are useless. Focus on what they are today and what they're going to be. I don't like shares outstanding being up. I don't like dilution. It's not the worst number in the world, but they're generating cash now, guys. Pump the brakes on dilution. Let's see what analysts think about the company. Actually, not as optimistic as I thought. December, going at $3 per share and earnings per share going to $4.60. That's roughly a 50% increase over the next 4 years. So, but they have, ironically, here's what we have. We have $6 here in 28, dropping to $4.60 in 29. That's interesting. But look at this revenue growth. 18, 15, 14, 11, 9. That's some serious revenue growth for a company that is as large as it is. It is a verb. But remember, story, numbers, we got to put them together. That's what we're going to do here with our stock analyzer tool. And guess what, guys? We're going to do that with Ferrari next, and we're going to do that with AMD afterwards. This is why subscribing to the channel is important, as a way of understanding how we use our tools and our software to make better decisions and to guide us along the way. So let me pull up the last time I did Uber. It is amazing to me how fast this channel is growing, and I love it. All right, so I did a 10-year analysis, guys. So I did 10 years. You can do 1 to 20. I put revenue growth at 6, 9, and 14% on my low, middle, and high assumptions. For profit margin, I did 18, 22, and 26. And I want everybody to keep in mind, this profit margin recently was a lot different, but in the last 5 years, look how different it was here. Earnings were more last year. Oh, but that doesn't include that tax benefit yet. Either way, I feel comfortable putting 18, 22, and 26. I could understand if it was higher than that, but right now I'm comfortable doing that. Now, What PE would I put on Uber 10 years from now? Well, the market average is 15 to 16. I always tell people, start from there, go up for a great company, go down for a crappy one. Now, there's a lot of great about this company. Growing, it's a verb, it's the market leader by far. Not great is this, but I think this will come through with time, this return on capital. That's an important metric we have to look at, like I talked about before. It is getting better, but it is something to pay attention to. I still feel comfortable putting 18, 22, and 26 for my multiples 10 years from now. And finally, 9% desired return. Guys, I do not recommend buying a company for a 9% return, but this is what's going to give you my intrinsic value. What's the company worth today? Because I can get 9 or 10% from investing in the market. But to buy an individual stock, I need a margin of safety. I need a higher return. But for right now, I'm just showing this for what's the value today. Hit the analyze button. This is why I'm interested. I have a low price of 86, high price of 301, middle price of 150. Guys, that means my middle assumptions occur. This could be a 15.5% return company. This is very, very interesting to me. Even on the low side, we're almost at the low side. We're at 95 bucks right here. It's 80, the low side's 86. I would buy it on 9 or 10% on the low side because I look at this saying, my low assumptions are, look how low my low assumptions are. 6% growth in revenue, 18% profit margin, PE of 18. I just look at this saying, I'm paying attention to this company. The question is, are you? Now, guys, remember, I'm going to do Ferrari next and AMD right after that. So stick with us. Let me go to Ferrari. Let's see how Ferrari is doing today. All right, guys, so here's Ferrari's results here before we go into the numbers in more detail in our software. Everything's in euros. Revenue up 7.4% versus the prior year. Total shipments of 3,401. All right, 3,401. They did it at the same time over and over again. It'd be 13,600 units. That's how little they keep out there, okay? Operating profit up 7.6% per year. Operating profit margin of 28.4. Profit up 5%. So guys, this is not a company that's going to try to hit home runs here. They're really trying to control how they do. All right, guys, here are their numbers compared to units. They've shipped 18 more units this year, same quarter than last year. 18 more units, 1% more. They didn't care. For the 9 months, also 1% more. They don't care. They're not they're not doing this for everybody else. They're doing it for themselves. Net revenues up 122 million euro, up 7%. Operating profit up 36 million euro, up 8%. The exact same margin. Net profit up 7 million euro to up 2%. Guys, I look at them saying, why do you guys even do expectations? Just run your business. You're an elite business. You're a business that doesn't give an F what everybody thinks. That's why you sell Ferraris. You don't sell Fords because you don't care about, you're not trying to sit there and say, we want to appeal to the masses. So why are you appealing to the masses here? Do what Berkshire does. Don't even care about that. Let's see if anything else matters here. Okay, this is by region. Shipments. China, Hong Kong, Taiwan, down 12%. America's down 2%. There's growth in Africa, and there's growth in other parts of Asia. Wow, that's pretty interesting. Kind of surprised to see that, but it shows you what might be going on in China, Hong Kong, and Taiwan. Are they having a slowdown there? Interesting. Americas are even over 9 months. Not even, but up 12 units. And Hong Kong, China is down 13%. That's very, very interesting. Interesting. Okay. There was talk for a while about Ferrari going to all electric, and they backed down on that one recently when electric started to lose its luster. An exact example, I want to remind people that a few years ago, you couldn't say anything bad about electric vehicles. It was the future. Everybody's going to do it. No question about it. Now, all these companies are pulling back saying, well, maybe we won't do as many electric as we thought. Things shift. Okay, let's go take a look at the company. Ferrari was actually up today 2%. Almost closed. It's pretty interesting. Got as high as 406 and currently about 400. Well, let's see what they reported. You ready? Revenue of 2.07 billion versus 1.98 billion. Earnings per share of $2.50 versus $2.35. They beat on both. They beat on both revenue and EPS, earnings per share. So, guys, Ferrari is one of the most amazing businesses of all time. This is a company that could probably sell 100,000 cars a year if they want, and they choose to sell 14 or 15,000. Why? They want to be exclusive. They want to have that brand that everybody wants, but not everybody can have. They could easily quadruple their profit if they wanted to. The other thing is, look at this gross profit, 51%. Most car companies are like 15 to 20% gross profit on the high side. They're at 51%. This is not just a car company. This is a lifestyle business. This is a business that has, hey, we're here for only the elite. They will ban people from buying their cars. They will say no to you. I once went into a Ferrari dealership to buy a Ferrari. I knew I wasn't going to get a Ferrari. I knew they were going to sell me one. I said to him, hey, listen, if I want a new Ferrari, what do I do? The guy said to me, go buy a used one, come into the dealership, bring us the used one, show us, we'll register you in the system as an owner, and then 18 months later, you'll probably get a new Ferrari. I was like, okay. And I loved it. I love that exclusivity. Just to let you know, in our software, I've said I want to be Ferrari. At some point, we're going to close down our software to new subscribers because I'm just going to say, if you want it, you got to wait till somebody else leaves. I don't know what size that'll be, at what point that'll be, but I know it's going to happen at some point in the future where I'm going to make it about having the right people in our community. The same thing Ferrari wants. They want the right people owning their cars. They don't want the wrong people. It's a $71 billion company with very little debt, about $5 billion in debt that generates $1.56 billion last year in cash flow. Now, our community has it as a hold and an intrinsic value of $246. Okay, here's the 8 pillars. What do we love here? 6 check marks, 2 X's. Now, does Ferrari deserve a premium? 1,000,000%. Absolutely. It's a premium company, premium brand, high returns on capital, 20% returns on capital, high margin. It is a beautiful, beautiful business. Guess what? That's what deserves a premium for it. The question is this the right premium? It's selling for 46 times free cash flow in the last year. It's selling for 79 times its free cash flow in the last 5 years, average. That's a lot. Let's see what analysts think about the company. They think the company is going to grow its profit per share by about 40%, from $10.37 to $14.34 in the next 4 years. As for revenue, high single-digit growth, $8.3 billion to $10.7 billion. Guys, it's an incredible business. And by the way, just to let you guys know, NASDAQ finished down 2.04%. That's incredible. That's absolutely incredible. All right, so what is Ferrari worth to us? Let's go pull up their stock analyzer. Here are my assumptions I made for Ferrari for the next 10 years. 4, 7, and 10% revenue growth. Maybe I'm being light on the 7%, but I'll still keep it there. Profit margin, 19, 21, and 23. As you can tell, their profit margin keeps increasing. Now, their free cash flow has been a lot lower in the past, but it's starting to catch up now, which is good because I was getting a little worried about that. What PE do you put to Ferrari? What price to free cash flow? Like I said, you start at 15 or 16, go higher for great companies, go lower for bad ones. I put 22, 26, and 30. Guys, I would fully understand if somebody in the community said, nope, it's got to be higher than that. It is the most exclusive brand out there. It's incredible how they sell. They literally sell like 14 or 15,000 cars a year. I don't know the exact number, but they don't sell a lot. They keep it, and their fastest growing market's Africa, which makes sense because it's one of the fastest growing rich areas in the world. Now, I put 12% return. I'm going to put in my 9% desired return for the market average. And just after this, I'm going to go through AMD. Here's my price. I have a low price of 178. Let me skip this. Let's choose my intrinsic value. I can report it. And a high price of 435, middle price of 280. So I think 280 to 300 is probably the right price in my opinion, but I got to wait for it to be much lower. I have my watch list at 250. So when it falls below 250, it will notify me. Now, maybe it never falls to 250. And as time goes on, I increase my value. I update my watch list so that the software emails me about that. Now, guys, before we do AMD, like I said, if you're new to the channel, I really encourage you to stick around, subscribe to the channel. You will learn a ton. If you've been following us for a while, even follow our main channel, I encourage you to check out our community and our software. Like I said, before I make it closed off to new people, I want you to remember, we're here to change the way in which people view money and the way in which they invest. We're here to teach people how to invest the right way, not necessarily just to get better returns, to sleep better at night. Because what people don't realize is when you're anxious, when you're upset, when you're emotional about money, that's when you make the wrong decisions. That's when you sell at the wrong time and you buy at the wrong time. If you're able to decrease that, you will buy at the right time and you will sell at the right time. Not the exact right time, but you'll be much better at it. This isn't magic bullet, but this is a way of thinking, a way of being. This is what we teach here in the community. So I'd encourage you to check out our 7-day trial. Click the link below. Only if you've been here for a while, because it's not for everybody. It's for the right people. So if you've been watching us for a while, you're probably along the right person we want to have. But if you're just looking for some flashy advice and some hot stock to pick, we're not the place for you. If you're looking to really understand investing, that's what it's for. So click the link below. Now, let's check out AMD and see what they have reported. So guys, AMD just reported. We don't know what the numbers are. They haven't been released, but now the market had first said minus 2.5%. That's how I know they reported. Now look at it. It's 1.2% up. Guys, this is why all this stuff just happens so randomly. This is why I don't want you to focus on quarterly results. We're going to break down the numbers here as soon as they're reported. And we'll go to the price that's right for AMD based on my assumptions. But I want you to remember, we love talking about earnings results, but we don't want to focus on them. That is a short-term viewpoint of a company. If you went and bought your neighbor's mechanic shop, would you worry about how it does on a week-to-week, month-to-month, quarter-to-quarter basis? No, you're going to look at it and say, all right, might have had a bad quarter, might have a better quarter, but it's about the long run. I have tons of business upstairs, and every quarter is not a good quarter for them. But we don't sit there and give up and say the price fell a ton in that time. So let's go check out what AMD reported. Guys, double beat. EPS, earnings per share of $1.20 versus $1.09 expected. $9.2 billion in revenue versus $8.7 billion expected. Wow. Wow, wow, wow. They beat by a lot, and look at them. They're just fluctuating back and forth. Let's see if there was the actual report has come out that we can pull up here on AMD's website. I'm not seeing it here oh, here it is. Here it is. Oh, wow. Gross margin of 52%. Let's take a look at all of this. Let's just look at the charts here. First off, we delivered quarterly revenue of $9.2 billion, up 36% year over year. So revenue right here, 36% year over year. Gross profit up 40% to $4.78 billion. That gross margin, 52%, up 2 points. So here's what's important. It is not easy to increase gross margin. That means every extra unit they sell, what percentage of that goes to the profit, the bottom line before taxes and overhead. That's a tough number to move, and they did it. Operating expenses, so even though their revenue is up 36%, their operating expenses are up 30%. But their income, operating income up 75%, operating margin went from 11 to 14%, net income up 61%. To $1.24 billion, and their diluted earnings per share at 75. I mean, absolutely crushed it, guys. Absolutely crushed it. And here was their diluted earnings per share on a non-GAAP basis that reported $1.20 versus 92 cents, up 30%. Guys, huge stuff here. Huge stuff. Data center segment revenue is $4.3 billion, up 22% year over year, driven by the demand for their 5th-gen processors, AMD. Data center has a lot to do with AI. It's these big data centers they build. These chips are high in demand. This is what matters. Client and gaming segment up to 73% year over year to $4 billion. Wow. Client revenue was a record $2.8 billion, up 46%. Gaming revenue was $1.3 billion, up 181% year over year. People still love to game. People still love the game. Then I asked the question of what happens when gaming, we did Netflix yesterday. What happens when gaming goes on Netflix and other online places? But I'm sure these chips have to do with computers and things like that as well. Wow. Let's check out some other stuff here. Here's a company I love talking about. Cisco and AMD announced expanded collaboration with G42 to deploy large-scale AI cluster-powered blah, 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 blah. Why do I love talking about Cisco? Cisco was the NVIDIA of 2000. This is a company that skyrocketed. I will pull up the chart here just to show you. Cisco. I love teaching this. So if you're new to the channel, it's really important you see this. Look at this chart. Cisco has not hit its high from 2000 of $82 a share. This was the company you had to have. Stocks in the short run are a voting machine. In the long run, they're a weighing machine. The stock went bananas. What's funny is from here to here, profit is up 10x. Stock price is up 10x from before the bubble to today. Why? Because in the short run, stocks are a voting machine. In the long run, the weighing machine. Take this away, and what you got? Pretty good looking chart there of a steady company that's growing. That's what Cisco was doing. But everybody said this would be the first $1 trillion company, and it plummeted afterwards. That's what I want to remind people all the time. That's why I love talking about Cisco. Unbelievable. All right. Dividend yield. Oh, that's Cisco. Sorry, let's not look at Cisco. Let's look at AMD. Down point. Okay, now up. All right. $400 billion market cap. Guys, this is a company that's selling for 143 times profit, 100 times free cash flow. That's a lot, guys. That's a lot. Look at the companies back in the .com age. This is what happened. Our community members have it as a hold. I actually personally think it's a strong sell, and $187 intrinsic value. The profit margin is 9.5%. Man, they can get better. Because when Intel was Intel even a few years ago was doing 20 to 22% profit, AMD is doing 9.5%. Interesting. Let's see what the analysts think about this company. Wow, look at this. $4 in earnings per share this year, growing to $10.66 in the next 4 years. It's a lot of growth potential, and revenue growing 20+% for the next 3 years, and then 3.5% stabilizing from there. But guys, even on those numbers, I think they're assuming a lot of great things. Now, guys, I'm going to do this stock analyzer, but again, if you're new to the channel, subscribe. If you're not new to the channel, been around for a while, and you think you're the right investor who is good for their community, who would get a benefit and also provide benefit, click our 7-day trial below, because I really want the best people out there for our community. So guys, here's AMD. I did a 10-year analysis. I did 8, 16, and 24% revenue growth. I did 8, 15, and 22% free cash flow and profit margin. Keep in mind, they've never done these before. I'm giving them a lot of benefit here. Okay? I did 18, 21, and 24 on both PE and price of free cash flow, and my 9% desired return, market return for intrinsic value. Hit the analyze button. Guys, we have a low price of 36, high price of 420, middle price of 140. I mean, it could keep growing. If it grows its profit by 30, 40% a year for a while, it would be okay. The question is, will that happen? Guys, thank you very much for your time. I'll see you in the next video.